Hey everyone, I hope you're all doing well out there. This is your September market review. So I had skipped last month's market review if you noticed, and we're moving right into this month because there wasn't a lot of news going on last month heading into the interest rate drop or interest rate announcement that the Federal Reserve was announcing here a little over a week ago now. And I wanted to wait to kind of get that news of what they were going to do as far as a 0.25% drop or a 0.5% drop. So for those of you that have not watched these videos before, the reason that I put these videos together each month typically is because I want to give my clients the straightforward information about what's going on in the stock market, the economy, and then ultimately how that affects their investments. So this past month, just a little over a week ago now, we got the interest rate drop announcement. That was a 0.5% drop, which was they were debating between 0.25% or 0.5% was the initial decision really that they were looking at. The reason for this is because interest rates or inflation has come down so dramatically on a year-over-year basis from where it was over a couple years ago now. One of the reasons that they raised interest rates originally was to help lower inflation, so that really helped out, and the goal at that point in time was to be at this point now where they could lower interest rates eventually. So the stock market reacted positively to it. I have a chart here showing the S&P 500 and the aggregate bond index from the beginning of the year through today, which I'm shooting this on September 25th. This is really just a good sign overall. You have stocks moving higher, bonds creeping up a little bit. Bonds should be moving up a little bit higher just because when interest rates drop off, the price of bonds go higher. So that's one of the reasons that move higher happened in September for bonds, while not dramatic. Bonds generally don't move in a very dramatic way. Stocks are a total return of 21% here as of today. If we tie in, the next chart I have here is pulling in one of the buffered strategies that for my clients out there I use for portfolios, especially if you have an IRA and you're a little bit more conservative. You have this fund in there. I use this as a replacement for bonds. That's the blue line in there. What it does is it buffers a drop of the S&P 500 from the beginning of January through the end of December on a 12-month cycle of 15%. So if stocks would have dropped off, that first 15% you're protected in if we hold that the whole year. On the upside, there is a cap. I believe it's about like 15% for the year. We're moving closer and closer to that. But so far, this fund is up 10% or almost 11% for the year. The S&P 500 is well through that cap on the upside, being up 21%. But this as a bond replacement has done really, really well because what I'm doing is replacing what we would be in an aggregate bond portfolio or something similar to that, which this has done about 6% better. So that's a way that, just within your portfolios, I'm trying to improve on the risk-adjusted return, especially for those of you that are a little bit more conservative with your money in IRAs. If you have money that is in a taxable account, I also use a lot of buffers in there. At times, if we have shorter term needs for it, maybe not exactly this buffer, but the same sort of idea versus using bonds, which, bonds just, even still with interest rates dropping off, bonds are not going to be a great long-term growth machine. So I'd really rather just use other tools such as the buffered strategies in order to accomplish the goals of just reducing risk. So because really the goal is to make money on the upside, but we want to reduce the risk if stocks do drop off and you have shorter term needs for that money. The chart that I have shown here is showing the S&P 500 over the last month. I'm going back to the very end of September. Typically, September is a little bit more of a volatile month, so we were down about 4% at one point, which you can see there. It was like September 6th we were down that much. So it's really rebounded a lot since then. A large part of that was the interest rate move that happened in the middle of the month. I believe it was like September 18th is when that happened, which you can see that big spike there. And since then, we've kind of just traded sideways. Right now, we're currently at an all-time high within the stock market. So Obviously within your accounts, you're also going to notice that as well. The interest rate cuts are really a huge part in the next chart that I have here. I got a lot of charts this month, so I want to give you guys a lot of visuals. It's been a couple months since I sent out one of these, so I have a lot of good visuals I've come across here over the last month and a half since the last video came out. So the interest rate cuts is generally a very good thing for the stock market, and unless we're in a recession, is a good thing for the economy kind of continually moving forward and helping it grow a little bit better. So typically in this chart here that we have pulled up is the S&P 500 returns after the first Fed rate cut. So in kind of an order of looking at some of these, you have your 1974, that was in the middle of a recession. That was a pretty bad time frame. 1974 and 1975, the stock market was down pretty dramatically in those years. 1980 was an interest rate drop, and that was really the turning point, because at that point, inflation was really, really dramatic. They lowered interest rates initially, and then again a little bit later, they decided to raise them, and then ended up cutting them the second time in 1981, which we went into a recession at that point. But that then, after that recession, spurred about a 18-year upswing within the stock market. So 1984, another interest rate cut after that just helped stocks grow even more. 1989, another good time frame. 95, another one. 2001, we were already in the middle of what was going to be a recession because of the dot-com bubble at that point. 2007, that interest rate cut, while stocks went up initially, was the start of the Great Recession, which was a pretty dramatic downturn. So, you can see what that did from a stock market drop. 2019, initially stocks went down, and then 12 months later they were higher. So if we're not in a recession, which right now it doesn't look like we're in a recession, it bodes pretty well that stocks are going to move higher. And I thought this was a good chart to just kind of depict that. There's obviously two sides of the coin. If we are in a recession, which is never really a certain guarantee, it just looks pretty likely that we aren't, being that unemployment is at close to 4%, and inflation is pretty low, and the jobs market overall is really healthy. It's a pretty good sign that we're probably not in a recession right now. We're headed towards one, at least in the immediate future. I thought that these were just some good charts to bring up, just because I have a couple other charts in here. Actually, I think 3 other charts in here that I thought were pretty good. But just to take a second between charts here, there's just a lot of good things that have happened this year, especially the stock market's reflecting that, we're at an all-time high. Inflation was the biggest thing over the last 2.5 years, and the fact that inflation has come down as much as it has and is back in that range of under 3% is a really big win for the U.S. economy, and a huge win for the Federal Reserve, because they had raised inflation at the highest, at the quickest rate in history, which was in large part because of how dramatic the inflation was, which all stemmed from the COVID stimulus and things that they were doing to help make sure that the economy didn't go into a deeper recession. So far they've done a really, really good job with that, and it's helped out the economy. It's definitely helped out the stock market, which we all like. And as long as they keep doing, a good job with, the monetary policy of that, and, are able to help with keeping the ship going in the right direction, stocks are going to be the place that we want to have money invested. So I have a chart here. This kind of ties into what I was talking about with September drop-offs here. This is just I saw this and I thought, being that it was September, we kind of beat the averages. So September is one of the few months where stocks are on average since 1928 down or negative. They're down a little bit more than 1% on average, where typically, on average, stocks are higher on a monthly basis. So I thought that was just something, worth mentioning, especially because, at least as of now, not that I'm shooting this, 25th. So not that there can't be increases, but or drop offs, I guess, between now and the end of the month, which is next Tuesday. So we got a couple days left, but more than likely we'll be in a positive spot, for by the end of the month, unless something dramatic happens. So last couple charts I have, and we're getting closer to election time frame. There's more political stuff that'll come up, and I just want to address this because we're pushing into October here. Is to not allow political. I wanted to bring up kind of a political chart just to talk on the politics part of things, because politics can play a lot can get in the way a lot of investment decisions just because of the emotion tied to candidates and things. But this was a good chart I just wanted to bring up just to show you the difference between the parties of Republicans, Democrats, and really why you want to stay invested regardless of who wins the presidency, because at the end of the day, it's not about who the Democrat or Republican in office. It's about staying invested, because all these companies that we're invested in are publicly traded companies, and they don't care if there's a Democrat or a Republican in office. While they might have, do better if one's in there or the other, they're still trying to make money and grow their profits, which then in turn will grow their stock price. So I thought that this was a good chart. It just shows on the very left-hand side the Democrats, Republicans, obviously in their red and blue, and then tying that over into the other chart showing since 1953, $1,000 in the S&P 500 has grown to about $1.7 million just staying invested, and that's with, I'm assuming, dividends being reinvested as well. Versus if you just pick Democrat or Republican and invest over that time frame, pretty poor investment returns in comparison, especially. So the big thing there is just staying invested and not allowing political opinions, beliefs to get in the way of really just your long-term investment goals. The last chart that I had, I thought was a good visual, so that way this can help you kind of understand how realistic returns are over time. And there's always, when we get to all-time highs, there's people that think that, well, we're then due to then drop off dramatically, which sometimes happens when you get to an all-time high, because inevitably you drop off from that point at some point. But typically all-time highs lead to more all-time highs. So this chart I wanted to bring up because I liked it just from a visual standpoint. It shows all of the S&P 500 annual performance going back through, I believe it's 1928. So it shows all of the years broken down as far as the rates of return, which most of the returns are going to be more closer to the median. So we're in the middle there. So if we're thinking of your high school stats class, so most of them are going to be in that that center spot there, and they fall generally within 0 to about up 30% is where roughly in that time frame you're going to see about half of the returns fall within there. There's your outliers at the very extremes where you're up 40 to 50%. There's 3 of those. All of those happen in more extreme time frames of either post-Great Depression or in World War II. And then the extremes on the other end also were, there's the one that was during the middle of the Great Depression in 1931. You have then the drop-off in 2008 during the Great Financial Crisis, which was the worst economic time frame since the Great Depression. Start of World War II, you have the dot-com from the 20 to 30% drop in there. That's in 2002. That's post 9/11 drop-off as well. And then you have the 1974. That was when inflation really started spiking, and there was a lot of issues involving inflation and oil shortages and interest rate hikes. So that was a pretty rough economic time frame. But for the most part, returns in the S&P 500 are pretty pretty normalized. And one of the reasons I use those 15% buffers, if we look at all those different years of negative returns between 0 and 20%, There's 11 between 0 and 10, and 14 between 10 and 20. I use that 15% buffer because it's going to eliminate most of that downside, which inevitably there are going to be those years, and one of those years was 2022, which for a lot of you, I was using that buffer in that time frame as well. So that's one way to help mitigate some of those losses. But this is just, I wanted to kind of give you that visual of over the long term how positive investing in the S&P 500 and stocks really is, and how, yes, there are the time frames where it's negative, but if you're concerned about that, there's ways like using the buffered strategies or other strategies that I can implement to help avoid some of those big drop-offs on the downside. So just thought it was an interesting chart, but if you guys have any specific questions for me, or you want to get together to do an investment review via Zoom, I'm more than available to do that here coming up here in October. Feel free to reach out to me if you have questions or you just want to schedule a Zoom meeting. If you ever want to schedule a Zoom meeting, you can always just go to an email that I've sent you, and you'll see in my signature there is a link to my calendar that says investment review. Click that link, and that'll schedule about an hour time frame with me. There'll be a Zoom link that's included in that when you do that. If you're somebody out there that's just watching this, you're not a client, you're interested in having a conversation, just reach out to me. I'd be happy to talk with you a little bit more in depth about your specific portfolio and see if I can help you out with improving on what you're currently doing, and just really maximize the efficiency of the risk and the return that you're taking within your current portfolio. So appreciate you all taking the time to check me out. Until next time.